All right, today we're jumping right into a mini consulting case. We're going to follow the life of a single bond. We'll track it from the moment it's created all the way through its life in the market and figure out its risks. The goal here is to build a mental toolkit that you can take straight into your next MBA interview or your next finance class. So let's get right to it.
So let's start with a really simple question. Imagine I have a contract that guarantees, no ifs, ands, or buts, that you will get $1,050 in exactly 1 year. How much would you pay me for that contract today? Now, you wouldn't pay the full $1,050, right? I mean, why would you? You could take a smaller amount of money today, say $1,000, invest it, and hopefully end up with that same $1,050 in a year. The amount you'd be willing to pay today, that's its present value. And that one simple idea is the bedrock for everything we're about to cover.
So here's our game plan. First, we'll nail down the basics. What exactly is the promise a bond makes? Then we'll see how its value and price dance around on the market. We'll learn the story that a bond's price tells you, look at the nitty-gritty of how it's traded, uncover a huge risk hidden in plain sight, and then we'll wrap it all up into a neat little toolkit you can use. Okay, let's start at square one, the promise. At its very heart, a bond isn't some crazy complex financial mystery. It's really just a simple, legally binding contract.
Think of it like this. A company or a government needs cash, so they issue a bond. You, the investor, come along and buy it. What just happened? Well, they've basically just signed a contract with you, promising to pay you back with interest. The two key phrases you've got to remember here are formal contract and fixed cash flows. These payments aren't suggestions, they are a legal obligation. And inside that contract, there are really just four key pieces. You've got the face value, that's the lump sum you get back at the very end, usually $1,000. Then there's the coupon rate, that's the interest rate they promise to pay you. The coupon frequency tells you how often you get that interest check, which is usually twice a year. And finally, the maturity date, that's the big day when the contract ends and you get your face value back. That's it, that's the whole promise.
So that promise we just talked about, it's set in stone. But the price you'd actually pay for that bond out in the open market? Oh, that's a whole different story. It changes all the time, which brings us to the single most important rule in all of fixed income, what I like to call the seesaw effect.
I want you to picture a playground seesaw. On one side, you have the current market interest rates. We call this the yield to maturity, or YTN for short. It's basically the total return you'd get if you held that bond to the very end. And on the other side of the seesaw, you have the bond's price. Here's the rule. They have an inverse relationship. When market interest rates go up, the bond's price must go down. And when market rates fall, the bond's price goes up. They always move in opposite directions. No exceptions. All right, let's put you in the consultant seat. Our client owns a bond that's paying them a nice, steady 5% coupon. But then, the central bank raises interest rates, and suddenly, brand new bonds are hitting the market offering 6%. Now, would you pay the full $1,000 face value for our client's bond that's only paying 5%? Of course not. Why would you? To make that older, less juicy bond competitive, its price has to drop. That's the seesaw in action, right there. So this means a bond's price isn't just some random number. It's actually telling you a story. It's telling you exactly what has happened to interest rates in the world since that bond was first born. And it breaks down pretty simply. If the market yield, the YTM, is higher than your bond's little fixed coupon, then your bond has to sell for cheap. It trades at a discount, below its par value, to attract buyers. But if the market yield is lower than your coupon, now your bond is a hot commodity. It trades at a premium above par value. And if, by some chance, they're exactly the same, it trades right at par. But here's the really cool part. No matter how wild those price swings get, every single bond has the same final destination. Whether it starts its life trading at a deep discount or a high premium, as it gets closer and closer to that maturity date, its price will always, like gravity, get pulled back towards its face value. On the very last day, it's worth exactly $1,000. Okay, now let's get into the nitty-gritty of how these things are actually traded. Because here's the secret. When you go to buy a bond, the price you see on the screen, that's not actually the full price you pay. And that's because of something called accrued interest. Just imagine a bond pays a coupon every 6 months. If someone holds it for 3 months and then sells it to you, they've earned half of that next coupon payment, right? It just makes sense. Accrued interest is simply a fairness mechanism. It makes sure the seller gets paid for the time they held the bond. You, the buyer, just pay them that interest they've earned up front. So when you boil it all down, every bond trade happens in 3 easy steps. First, the buyer and seller agree on the clean price. That's the quoted price we see, the one that reflects the seesaw effect. Second, the system calculates the accrued interest based on how many days have passed since the last coupon. And finally, the buyer pays the dirty price, which is just the clean price plus that accrued interest. Simple.
And what you get is this really interesting visual pattern. The clean price moves up and down smoothly with the market. But the dirty price, the actual cash changing hands, it follows a sawtooth pattern. It ticks up a tiny bit every single day as interest accrues. It climbs, 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 and then bam! On the day the coupon gets paid, the price drops straight back down to the clean price. And the whole cycle starts all over again.
All right, now for arguably the most important part, risk. The most common number you'll ever hear for a bond's return is its yield to maturity, or YTM. But this number has a massive, hidden flaw that you absolutely need to understand. So here's the deal with YTM. It's built on this one giant and kind of shaky assumption. It assumes that every single coupon payment you receive over the entire life of the bond can be immediately reinvested at the exact same rate as the bond's original YTM. Now, in the real world, where interest rates are changing constantly, what are the chances of that happening? Pretty much zero. This is what we call reinvestment risk, and it's YTM's single greatest weakness. So, if YTM has this big flaw, what should we be looking at for risk? Well, the answer is a metric called duration. Put simply, duration is the #1 measure of how sensitive a bond's prices is to a change in interest rates. If a bond has a high duration, that means it has high sensitivity and a whole lot more risk.
So what gives a bond a high duration, a high level of risk? Two things: a really long time until maturity and a low coupon payment. I mean, think of a 30-year zero coupon bond. That thing is the definition of high risk. On the flip side, a bond with a short maturity and a big, juicy coupon payment will have a low duration, making it way less sensitive to those wild interest rate swings.
Okay, we've covered a ton of ground. Let's package all of this up into a practical toolkit. This is the stuff you want to have absolutely locked down before your next finance class or, more importantly, your next interview. Here are the 3 most crucial takeaways. Number 1, the seesaw rule. When interest rates go up, bond prices go down, always. Number 2, YTM's big flaw. Its promised return depends on a totally unrealistic assumption about reinvesting your coupons. And number 3, and this is the big one, duration is king. If you want to know a bond's real interest rate risk, you look at its duration. Period.
And with that in mind, here are 3 questions you should be totally ready to crush. First, the central bank just raised rates. What happens to a 10-year bond's price and why? You know this one. It's the seesaw rule. Second, can you explain the difference between a bond's clean and dirty price? You got this. It's all about separating the bond's fundamental value from the timing of the trade. And third, why is a long-term zero coupon bond so much riskier than a short-term high coupon bond? And the answer, in one powerful word, is duration.
So let's leave you with one final thought to chew on. We figured out how to measure the risk of a single bond using duration. But what happens when you're a portfolio manager and you're not looking at one bond but 100 of them, or 1,000, all with different durations and different risks? How do you manage all of that? Well, that's the central challenge of modern fixed income, and a fantastic place to continue your learning journey. Thanks so much for joining us.